Good afternoon, everyone. Gabe Velazquez here with you, transparenttrading-solutions.com for a Tuesday, 7th March. Welcome, everybody. So today, looks like Chairman Powell came out swinging today, and it seemed like the market just refused to believe him. Made a comment of that on on Friday's show. Is the rally from Thursday and Friday was basically again markets thumbing its nose at the Fed. So in any event, welcome everybody. Hope everybody's having a great trading 2 days so far. We still have a lot more stuff to look at this week. So back and forth. That rally. Let's get into the S&P. Simply what happened is the Thursday, Friday, yesterday's rally peaked right at where it broke out from. Again, if you pull up your charts of the S&P, we had a big range in January between 4,100 and about 4,200. This latest rally took us right back to the bottom part of that range, right around the high was like 4082. That's mean reversion trade that I talk about quite a bit. I teach actually that to my members, and again looked very bullish. But as we know in this environment, where it really comes back to is what I've been telling you guys and gals here is we are gonna stay in this trading range. What that means is you as a trader cannot be dogmatic, cannot be chasing. Dogmatic meaning you can't say, oh, I'm just bearish all the time, I'm bullish all the time, because obviously that is not what's working right now. You have to be flexible. You have to understand where the edges are. And also breakout trading is something that's been working more or less because of, when you're in the middle part of these ranges, for instance, today, some would have taken and seen the rally as a tailwind for stocks to go higher. Some would have actually seen the resistance and so on and so forth. So, by the way, incidentally, I am going to have a class next Tuesday. So if you guys want to sign up for that class and any of the goodies, just go down to the link below. But I am going to have a class a week from today at 4 o'clock Pacific. And I am going to be talking about my strategy we've been implementing, which is a breakout strategy, but not what you think. So I know some of you, most people actually, get whipsawed on a lot of the breakout trading, but I do have a specific strategy that I'm going to share some with you. So if you're interested in that, go ahead and hit the link. That would be a week from today, and I'll be tweeting about it as well. Okay. All right. So, where are we at right now? We are right back to range trading. Now we can, again, we have JOLTS number tomorrow. We have the non-farm payrolls on Friday, and really that sets up for who knows. I mean, just like today, could we have a softer jobs number and have this thing rally right back up again? Absolutely, yes. You have to be open to anything at this point. Market is just data dependent. Every little data piece, and today was Chairman Powell just basically beating the market over the head, saying we're going to have to go longer, higher. But keep in mind that the data, just like what they talk about, they probably were surprised, just like everybody else, with the hot inflation data over the last couple of weeks, and all kicking off with that really blockbuster jobs number back 4 weeks ago. And so now this next jobs number is going to be very, very critical, more or less, because I think that's going to set the tone for another, if it comes in softer, that would probably, be bullish for the market and so forth. So unless you actually know the number and even know the reaction, It's going to be interesting. So bottom line is this, everybody. We've got 4,100 now again as the next resistance. We actually set up another level based on the fact that we dropped out of there today. On the bottom side, we talked about that 39.25. I think this go around, if we do go down there, this will be the second go around to that level. I think we break that down. So if we get a hotter than inflation number, I think the market goes all the way down to 38.50. That's the next level on the S&P, and then go from there, right? So it's basically, again, data dependent. You can clearly see that on the charts. I mean, if you just take your chart of the S&P and look at it from December, mid-December, what's the pattern? Chop, 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 a break, return to the origin of the range, rally again, chop, 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 return to the. So that's been the pattern. And, until that changes, like I tell my members, you trade what you got, you trade how the market is. You don't trade what you wish, hope, or dream is going to happen. And that is what it is. And so you have to make the adjustment. There's still, 100-point moves. We've got a few of those 100-point moves here and there. If you're patient, you can still catch these, but you can't, you have to kind of lower your expectation to have any kind of runaway trade, more than, about 100, 150 points. That's really been what the market's been giving you. Okay. So, similarly, the NASDAQ really not as clean. We actually did take out some level on the NASDAQ. We got a spike. So the NASDAQ is a little bit kind of more erratic, if you will. The levels are, the ranges aren't as symmetrical. In other words, you've got a lot of whipsaw and so forth. That's what makes it really, really tricky. And on the NASDAQ, I'm looking probably all the way down to, 11,540. And you got to be really careful with the NASDAQ. Is again, very erratic type of trading, back and forth, lots of whipsaw. That's part of the reason why, when I focus on these breakout trades, I'm only primarily focused on the S&P because it's the highest volume, the most liquid market, and therefore has the cleanest levels and the better kind of situations. And so I don't really, NASDAQ is a little bit off the table. Even levels on the NASDAQ, if you've been attempting to trade the NASDAQ recently, buying at demand or selling at supply, it's been tough. So you got to be very careful trading the NASDAQ. I would just stick with the S&P right now for the major averages. Also interesting, the Russell actually did hit a level yesterday and came down, and it's right at the bottom part of the range as well. So if you, I mean, this is pretty self-evident here. I mean, all you got to do is look at your chart. So the Russell at 1874 is now at a support level, and we'll see if that breaks down from there. And really, the next level is going to be around 1800 on the Russell. And the Russell, if it breaks down, it's going to have some really nice areas there as well. So I would not neglect the Russell, the small caps, and even the Dow. I mean, the Dow had a nice bounce, but the Dow also is very erratic, just like the NASDAQ. Levels really aren't working that well on the Dow. So I would just, again, I would stick principally with the S&P on the index. Bonds. So bonds, interestingly, I've been talking to you about the 10-year, and I even though we did have, we did sell off in the S&P, it wasn't like it wasn't like just a fall off the cliff type of sell off. It was just kind of a meandering lower. And one of the things that was really interesting today is the 10-year did hold above, that low here recently, that 110.12 level, right? So that is really interesting on that front. And again, if the 10-year breaks below 110.09, then I think that's going to be very bearish for stocks. So I still am of the notion that rates are the main driver. The data and rates are the main driver. So you've got resistance at 112. You've got support at 110.09 on the 10-year. It's kind of mid range here. So watch the 10-year going forward. And what was interesting is the 30-year actually was up on the day. I know because we were trying to get long TLT, and that actually was up on the day today. So again, this yield inversion that everybody's talking about is at historic highs. I think the 210 is about 100 basis points. In other words, you're getting 100 basis points more on a 2-year note than you do on a 30-year bond or a 10-year bond. So it's pretty wide. And again, people pointing to that as a recessionary indication. So whether that actually, is a good forecasting tool, we'll have to see. But for trading purposes, got to look at the 10-year as the leading indicator in terms of interest rates and see in the short term, right? Long term, it's all going to be about inflation in the long term. Okay, and then the dollar, interestingly, again, not a surprise. We talk about this all the time. Stocks moving lower, dollar moving higher, and the dollar now is right at a resistance level, 105.63. Look at your charts. If you look at your charts of the Dow, of the Dixie, we were right up against that. We talked about 100 being the ultimate low and getting somewhat bullish on the dollar. By the way, it did hold again, that 104.29 I've been talking about, that accumulation level. So we came in there yesterday afternoon, and then the Fed and the stock selling off really had a big surge in the dollar. That impacted all the currencies, all the metals. You saw silver down sharply, gold down. Actually, silver was the one that took the brunt. In fact, we were in a silver long, very small position. We took a very small loss on silver. And we were in the puts. Unfortunately, we got out of those on Friday, but it is what it is. That doesn't move a whole lot. There are some really nice levels coming into silver below current price as well. But again, it's going to be predicated on the dollar. Those will not work. Any kind of any longs on currency, any longs in the metals are not going to work unless the dollar stabilizes or actually comes down. One thing that was really noteworthy, and I'm still looking to get long, is copper actually held up better than silver or gold. Silver was the bigger mover today. You can clearly see that, and we are coming into some really nice levels around the $20 area in silver. So check that out if you're interested in taking a shot. But again, remember, these will not work unless you have a pullback in the dollar, and so you have to kind of line up and by extension. So if you really kind of link this whole thing together, dollar will not come down unless stocks rally, right? And so ostensibly what you're doing is when you're buying gold or silver or buying any kind of currency long, futures currency, because it's pegged against the dollar, your bet is that the stock market will rally. Is it right? Because again, if the stock market continues falling, that implies that the dollar is going to continue to rally. And so by that correlation, by that relationship, these metals and currencies will continue to fall. So keep in mind that, and we do that also in our for our memberships. We don't want to pile into a bunch of long currencies and metals, especially when the dollar is this strong. You never know, but your odds of it's almost like you're taking the same trade. So maybe have some offsetting trades for that. And an offsetting trade would be, short metals, short currencies. That would be almost like you're short the stock market. So it's interesting. And put your charts up side by side, and you can actually see the corollaries. Very, very strong right now. That whole rates, bonds, and stocks all very, very closely tied together. Okay. Um, yeah. In fact, also oil got hit today as well. And I would say it got hit as a direct result again of the very strong dollar. And so, but all in all, 82.50 is still the bottom end of the range. We're kind of just very, very, again, kind of erratic back and forth trading in oil. That's why we haven't really been trading oil futures per se. We've been more, we still want to get long USO because, again, with options and because USO can allow us to withstand some of the volatility and not get all chopped up with some of the moves in oil. Now, granted, I mean they've been pretty nice moves, but again, levels haven't been working. There's a lot of pivots. It's in the middle part of the range, and so that's again becomes a challenge. It's almost like trading the futures markets in oil. You got to be super nimble. Maybe catch some momentum here and there, but it's been a very, very tough market. Nat gas. So we had a big gap lower, as you all know, on Sunday in the nat gas futures, and we traded all the way down to 250, which is really what I've been talking about is in terms of staying bullish nat gas, and we have recovered somewhat. There's that big gap to fill. In fact, we are long Boyle. We're actually just flat. I think Boyle is right almost where we bought it. We're down a couple of bucks. Where did it close? Yeah, 621. We're long from 38. So, we're down like a few bucks. And it is a relatively small position. Now, here's the thing. Can we trade around our long Boyle position? In other words, can we short the futures contract or the mini contract, which is what we tend to do? Absolutely, yes. So just because we're long Boyle, that's a very long-term position. You could still go in and trade around the futures market. And so I am looking to, in fact, I was looking to short nat gas. I think I told you guys there's a really nice looking level around 310, but never got there. We had that huge pop in nat gas on Friday. And then we just had that massive gap because of the weather changing a lot. So a lot of what's driving that gas right now is weather and so forth. So, but the next level would be a gap, and then above that gap 310. And at some point, I do see nat gas working its way back up to 5 and 6. But it's going to be all weather related, and it may take months. Who knows? And again, who cares? I mean, that's why if you're just with the Boyle and you have a long-term view, if you're in it at 6 and you trade out of it at 30 and it takes 3 months, 4 months, nothing wrong with that. That's a pretty nice return. Okay. Tomorrow we have grain report. So I'm going to finish up here. Tomorrow we have a big grain report noon. Soybeans, big range, very, very distinct. 1480, 1555, right in the middle part of that range. Let's see if tomorrow breaks this thing out with the grain report. Wheat just came down to $7 a bushel, trying to hang in there. Again, very choppy trading. And then corn is the one I'm focused on for a rally back up into the 670 area. And now it's also starting to form a bit of a consolidation here, corn between let's say 630 and about 642. So, but tomorrow is going to be a big day in the grain markets. We got, lately, I have to tell you, I mean, lately we haven't really had a ton of movement after the grain reports, but maybe as we get closer to harvest season and so forth, maybe more volatility kicks in the grain market. So that's going to be tomorrow. So if you're not in that market, just expect a lot of volatility. Be cautious with that if you're not sure on, you don't want to jump in front of that report if you're kind of more of a novice type trader. Okay. All right, everybody. So just to wrap things up, we still got JOLTS tomorrow. That's the job openings. I think that's going to probably impact the market early on. We also have the big one is going to be non-farm payrolls. No question about it. That's Friday morning, first thing, 5:30 Pacific. Again, if you want to sign up for the newsletter, the class I'm conducting a week from today, in fact, go ahead and sign up below. I'll be tweeting about it. Uh, it's actually been one of the strategies that's actually been working in this environment. So you may want to take a look. Okay. Other than that, have a great rest of your week, everybody. I'll see you on Friday. Take care.